Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's just coming up on 20 minutes past 1 PM on Thursday the 18th of February 2021 and we're going to spend the next few minutes looking at TLT, which is the 20-year Treasury, the ETF for the 20-year Treasury. So interesting chart this is at the moment. I haven't covered TLT on the channel, I don't think, yet. I have had a chart on it for a while. I've recently updated it and I want to share with you today because I think there's something interesting to consider. So first things first, if you're new to the channel and you don't know how we set up a chart, let me just give you a quick rundown. We have 4 exponential moving averages, which are the yellow line, blue line, orange line and green line, and the yellow is the 10, 20 is the blue, 60 is the orange and 250 is the green. We have a volume profile on the right hand side, which is a visible range and adjusts when we adjust the chart. We have a built-in point of control, which is the yellow dashed line. We have an RSI set to a 10 close with the 30 green level representing oversold and the red 70 level representing overbought. We have a MACD with a 10 for the short-term moving average and a 20 for the long-term moving average and a 9 to smooth. Right, and so here we are on the weekly time frame. We're just going to do what we always do on this channel. We're going to start with our basic technical analysis and then do our Elliott wave analysis second. So in this case, the basic technical analysis is telling us quite enough on its own, I feel. Right, so first things first, bonds have been selling off. Okay, we know that because interest rates have started to creep back up. So the TLT here has been selling off. It's been selling off since it peaked back in unsurprisingly in March of 2020, and since then we've had a move down, a move up and then another move down, so likely a corrective move of 3 waves with 5 waves in the sea developing here. It's one way of looking at it. We are in an extremely bearish trend on the MACD. The most sustained bearish trend you can see here weekly time frame, if you look at all this bearish activity in red bars on the histogram here, we've just got wave after wave after wave of bearish momentum here. It's just been week after week after week of bearish momentum, long-term downtrend in the short-term moving average, crossing underneath the longer-term moving average and simply staying there. We also have the price itself now below the 10, the 20 and the 60 exponential moving averages, and we can see if we just zoom in here on the shorter time frame, we can see how the price currently trading pre-market at 145.01 below yesterday's close, but not below yesterday's bottom. So we're still trading inside, well, this is the week, so weekly we're still trading inside of the weekly candle at the moment. We are not going to open lower. Well, it appears we're not going to open lower for the moment. We are below the 10, 20 and 60 like I said, but we've got the 10 and the 20 exponential moving averages on the weekly time frame crossing below the 60. This is very fundamentally very bearish. It's what we call a death cross. The worst death cross, if it were to occur, would be when all of these are in alignment, all trending down with the 60 and cross over the 250. That would be extremely bearish. So overall looking pretty bad. Bonds continue to sell off, interest rates set to continue rising. However, there is one thing to consider, which is the RSI. Now the RSI is giving us an extremely oversold reading, right, for the weekly time frame. This is of 26.32. So this suggests to me that we've probably overdone it a bit. You know, we've probably pushed bonds down a little too far, and some kind of temporary short-term pop or bounce is at least on the cards, I would have thought. So if I show you why I think that, if we just look back at a few previous weeks where we can look at these bottoms in the RSI. So let's take this one down here on the 1st of October 2018. This coincides with this low here in the price. If I show you what I mean, I zoom in. So we reach a low here on the RSI at 24, and we reach a low in the price 4 weeks later. We just take a little dip. We also go low on the momentum. We fall down, we get a positive divergence, bullish divergence between this low and this higher low on the RSI, and we get that negative, so positive divergence in momentum because the price set a low and the lower low price, low, higher low in the RSI, and that was a major pivot. If you see on the weekly time frame here, that was a major pivot in the bond market. 1, 2, 3 waves move down, major low reading on the RSI, bullish divergence, huge run up in bond price, In other words, a big crash in interest rates. Okay, interest rates going lower and bond prices going higher. Of course, inversely correlated. That's the word I'm looking for. Right then, so let's go and have a look at another couple of these pivots. Right, so we've got another one here. Okay, another one here where we set the low. Now we get the exact same kind of condition here. Let's come down and examine this low. We get an extreme low in the RSI right here on the 16th of December. This is this low here. See, we come down, we pivot back up. We set the low in momentum here, but then we come back and set a lower low in price, but we set a higher high in the RSI, back out of oversold conditions again. So this is the same pattern, lower low in price, lower and then lower low in price, low and then higher low in RSI. Okay, then we get a start of another bullish move up. Right, so here, before we have that big sell-off down to here, so another bounce. Didn't quite get to extreme oversold conditions here, but we did back in here. So once again, it's the same pattern. We get an extreme in momentum on the 17th of June 2013, which is this red candle all the way back here. We set a low and then a lower low in price, and we set a low and a higher low and a higher low in the RSI, and that signalled that the bullish divergence in momentum signalled this big rally in the bond market. And I mean, I'm going to get boring in a minute, but it's the same story back at this low and this low and this low and so on and so forth. Okay, and all I'm trying to say is we're approaching the exact same conditions here in the RSI now. But remember, let's remember what happened. We had a move down, right, to set the momentum low in the RSI. We then had a move up in bond price, and then we had a move down to a lower low in price, which coincided with a low and a higher low on the RSI before a new rally up. That's where I'm going to leave the basic technical analysis, I think. We will just pop down to the day time frame for a moment to see what we can see, but it's even uglier. It's even uglier than on the weekly time frame. We can see that we are now below the 250-day exponential moving average, which, having been on a long-term move up, is now rolling over. We've had the death cross with the price below. Yes, we could bounce above it, but we could with the price closing below this death cross. That's bad news. You know, long term, that's bad news. So yes, I do think a bounce is coming sooner or later, but I don't think we're quite at the bottom yet. I think this is going to drive us down lower, which tends to fit my Elliott wave count. So I may have just sound like I've contradicted myself because I was saying, well, we're looking for that low in the weekly time frame. Yes, we are, but that's in the weekly, and as we saw, it can come down low, spend several weeks rallying, and then come down to a lower low on the weekly time frame to find that bullish divergence on the weekly time frame in the RSI. Now, why would it be that a pattern which is held up time and time again would break now? I think we're going to be looking at the same thing in the next few months. We're going to be looking at the same thing. Okay, now on the daily time frame, let's just give you a quick run through the count. So from cyclical wave 2 bottom back in March 2010, we've had primary wave 1, 2, 1, 2, 3, 4, 5 on the intermediate time frame into 1, 2, and then we've had our 1, 2 intermediate time frame 1, 2, 3, 4, 5 minor time wave running us up into July 2016, bottom in the intermediate wave 2. Now I think we're going into the intermediate wave 3, 4. Obviously none of this is to scale, this is all waiting for me to put onto the chart. 3, 4, 5 and a 3, 4, 5 into a cyclical 3. So I'm saying a long-term bullish move up in price for bonds is coming. We're in a big protracted sell-off at the moment. You know, it's no surprise. No surprise. Risk assets are flying high, stock market is flying high, bonds been selling off all year and all of last year basically. Not a surprise. Bonds continue to sell off, stocks continue to soar. Sooner or later we're going to see the appetite for bonds come back. Once we reach this 2, like I said, we could be in it now. We come back up, then we come back down for one more low, set that positive divergence on the weekly time frame, and up we go into a wave 3. Okay, so that's all I'm saying at the minute, guys. There's not much else to talk about on TLT at the moment. We're in a major retracement. If we are in a 3-wave move down, right, which this is what this big move here, and then move to here, and then move to here represents, then taking out the low, let me just find it for you guys, taking out the low at 138.89, that would confirm, that 3-wave move being complete. If we're going 3, 3, 5 waves down, then it would make sense to come down below this. We don't have to, we can complete earlier, but you could have a... let's just see what we've done so far. It's probably not a bad idea, is it? Let's have a look. We're right in the yellow zone. Okay, so if we're looking at a regular flat, we could be, arguably, you could say we're bottoming now. Right, but we've come through the 61, we've wicked through the 65. Here's this little area of volume here in the volume profile around our current price, 144. You know, if we were to have come down to this and find this as major support, I would have expected to see a bounce. We haven't, we've kind of malingered and fallen lower, so maybe an extension of the A or parity with the A. Parity of the A would bring the price all the way down to here, which is 131.07. So if we got a C to A parity in this correction, we'd be looking, I'll put a line down here and I'll call out, let's just get which one do I use? I can never remember. It's underwriting, isn't it? Call out. Let's pop it on here. Okay, so wave C to A parity. I said AVE. Hang on. Wave C to A parity 100. Don't need to write that, obviously. Why am I using the word parity? I meant to write the price. So 131.09. So there's your one-to-one target. If we're getting a one-to-one target, then we're only just getting, we've got a long way to come down in price. Now, we are oversold. Remember, I said that on the weekly time frame. We've had this incredible bearish momentum, worse than we've seen for a long time in the bond market, in the MACD here. So we could do what I was saying. We're getting oversold to extremely oversold levels. We bounce, only to set a lower low in price to get our one-to-one. Well, this would be the one here, this would be short. We could come down even further to one-to-one, and then we could get moving. Once, if we do bounce and then come down lower, we need to be looking for that bullish divergence. So a low and then a higher low on the RSI, a low and then a lower low in price. If we see that form like we have multiple times before, even if it were to start to form here, because we are still around that 61.8 to 65% extension of the A. So it could just be a regular flat. But if we are coming lower and we're going to do a one-to-one C to A ratio, then we'd be finding it down here around 131.09. That's it really, guys. That's all I've got to say about TLT at the moment. It has been a very bearish year for bonds in price. Obviously continue to sell off as and in the very bearish territory here as all the moving averages cross over. Interest rates continue to rise. A spike in interest rates, obviously, even with a move back down in interest rates temporarily before seeking out another low, that would be incredibly detrimental to high risk assets and high levels of debt. So, you know, the stock market would suffer under those conditions. Corporate bond yield, corporate bonds would suffer under those conditions. Well, corporations would suffer under those conditions. So everybody is leveraged up, which is just about everyone. Anyway, I'm in danger of wandering off into fundamentals, which I don't like to do. So if you're new to the channel and you've liked what you've seen, please subscribe, smash the like button, and if you feel like it, let us know what you think in the comment section below. I'm going to try and get another couple of videos done today and tomorrow, hopefully, and I'll be back with you shortly. All the best. Take care.